In this video, we're going to do a quick survey of the damage caused so far by the COVID-19. We now have a few data points that we can begin to assess the impact of the virus on economic activity around the world. The first one we'll have a look at here is global GDP growth rates. As we can see in the most recent entries here for the March quarter, we have a EU came out with a GDP down 3.8%. That's almost a 16% annualized decline. I suppose as some countries within Europe were closed a bit earlier than those of in the US. In the US, the economy contracted by about 1.2% or 4.8% annualized during the quarter. We don't have Japanese data yet. That'll be out in a couple of weeks. We know in Q1 that economy already suffered a close to a 2% decline or close to a 7% annualized decline. Estimates there seem to suggest a contraction in the order of 10%. Likewise, in the June quarter for the US, the expectations are for a similar a sort of 10% decline. So the numbers are starting to come in, probably worse than expected in Europe and possibly also worse than expected in the US. Elsewhere, if you sort of look at some of the partial data, we know the service sector PMIs have been down a long way. It's hard to sort of put these into context really, given they're so bad, but service sector PMI in the Eurozone basically collapsing to 12, as we can see there. Our European GDP growth model, I guess similar to what we were just saying earlier about the European GDP data, based on the PMIs, both manufacturing and service sector, we're expecting GDP growth to fall to something like minus 12%. So that would suggest another big quarterly decline in the June quarter. And then most of us also heard about the data coming out of the US on unemployment claims. They're running at around about 30 million over the past 5 to 6 weeks. That's on top of the 7 million that were already unemployed. So that places the unemployment rate potentially well above 20%. In terms of just a couple of other items while we're talking about the US, we already talked about the fact that GDP there slowed 4.8%. This chart's just looking at the contribution from the various sectors. You can see here the big blue bar, that's the most important component of the economy. The consumer actually detracted about 5% from, or more than 5% from the economy's growth rate in the most recent quarter. Likewise, investment also detracted, and inventories, there was a build-up or an inventory factor there. The only real positives were in net exports and government spending. So consumer obviously at the heart of this, and that shows out when we look at the various components of consumption. We can get a really quick sort of feel as to what's been hit. And I'm only looking at the data to the end of March. This is so just for one quarter, and you're just seeing the spread of outcomes depending on what sector you're in, and these are in real terms. So in the March quarter, spending on clothing and footwear declined by about 10%, and there were declines of at least 8% in automobiles, recreation, and food services accommodation. So those sectors were hit particularly hard, while on the other hand, we had the food and bev area, which was up around about 5 or 6%. So quite a divergence of outcomes, as you can see there. So let's just move along. Before we do, one other interesting observation in the US data for the March quarter was the rise in the savings ratio. So the pink line here is the savings ratio, and we've smoothed it, but it actually rose to about 13%, which would sort of put it, and it's smoothed, it's 10% really back to levels not seen since the 1980s. This is quite an incredible turn of events. Consumers are much more cautious, obviously, than they have been for some time. They did that after the GFC. Savings rate fell away for a while, but has lurched higher again over the past 12 months, and particularly in the most recent quarter. So a very high savings rate coming through. So what about in terms of Australian data? Well, we haven't had a lot of data observations out just yet. We heard the consumer sentiment numbers. They were down sharply. through GFC levels at a reading of around about 75. That was for April. We've seen some NAB business conditions data for March. Probably most noteworthy, this is on an industry basis, the red dot represents the most recent observation, was in the normally steady, predictable recreation and personal services sector. You can see the decline there way outside the normal range of outcomes. And likewise, mining was down. It was down across the board, essentially, as you can see there. And surprisingly, I suppose the private sector credit numbers out just the other day. The big component, which is housing, this is investor housing, was down. Owner occupied was up slightly, but you can see the weakness in investor housing. That we know that story, that's been with us. But interestingly, the pink bars, which represent business credit on a monthly basis, actually expanded by almost 3%, the highest really we've seen on this time horizon, higher than during the GFC. And this reflects the fact that corporates were drawing down their credit lines during March, and that led to an explosion of credit outstanding in the system. So that was an interesting observation. Now what I want to do is look at some performance of markets, sectors within markets, factors, and also earnings. And I turn to looking at global sectors here first. And on this chart, all I'm doing is showing the performance since the end of January across the key global equity sectors. And it's no surprise that energy was the biggest underperformer, down about 40% at one point from the end of January, subsequently recovered during the month of April, and in fact now is even outperforming the bank sector. So that's certainly not a very good outcome. Banks still down, about 30% below where they were at the end of January. So they've been the worst performing of the key sectors. Elsewhere, industrials very poor. You can see those there. And where we've seen the biggest improvements in the month of April, which is obviously a very strong month in equity markets, was in IT, which was up and is now down only about 4 or 5% since the end of January. Healthcare is clearly one of those that's going to benefit from this, and they're basically in line with where they were in January. So healthcare and IT are probably the better performing sectors, while banks, energy, industrials, and that's REITs have been some of the underperformers. So that's on the sector basis. What about looking at the performance of some factors? And I'm only looking at a limited range here, but the biggest disappointment has been the performance of value. Value is still down about, that'll be about 18% from January. This is in net US dollar terms. Certainly recovered like everything else during the month of April, but still down quite a bit. The outperforming sector has been growth, or factor has been growth, and that's now off about 6% from the end of January and put in quite a sharp recovery, and now put it ahead of quality as a factor. So you can see the continued underperformance of value versus growth, and quality still doing very well. So let's just now turn to some sectors and earnings. And so I'm going to go through a number of global sectors, more interested in some of the standouts in terms of the changes to forward earnings or expectations since the end of January, and or actually since the end of December. So what we've done here is looked at the previous recessions, and we've called the recession beginning at the end of 2019. So you can see the different recessions there, and the progression of whatever it is we're looking at. So in the case of here, I'm looking at earnings, forward earnings estimates. So for pharma, the biotech earnings have dropped by about 2 and a bit, or less than 2% over the 4 months since December 19. So GDP, as you can see there, in the first quarter in the US was off 1.2. If we add in what the projections are, you can see that with another big decline in the June quarter GDP, this is what we think GDP will look like over the coming 2 quarters. Obviously a lot worse than previous recessions. But anyway, back in terms of earnings, the standouts on this page would be transportation as a sector, with forward earnings estimates down almost by a third. The others are pretty reasonable. Metals and mining off 20%. If we just push through some of the other sectors, we'll see materials down 20%. Technology, you can see there, only off 5%. That's the forward earnings numbers. This is up until last week. Using consensus numbers, the banks, probably the big disappointment, even a lot worse than previous recessions, and even a lot worse than the GFC, which was one where the banks were at the core of the issue. But bank earnings down about 27%, or forward earnings estimates down 27%. Energy off close to 70%, and so on. If we look at the Australian sectors, I'm just looking at the most recent, since January 20 now, just since COVID really took hold. And I suppose, again, the standouts here is earnings in the energy sector off 55, but I just did want to point out the overall market forward earnings numbers are down about 16% so far, with financials down about 18 or 20%. So significant drops there. Now, at a regional level, let's just have a quick look at that. So we're just surveying the damage so far. So Europe has probably been one of the biggest areas hit, with forward earnings numbers down almost 25%. That compares, as we saw, to Australia at about 16, the US at around about 10 to 15. So global ACWI is down close to 20%. So they are probably the standouts at a regional level. We do have some data here on Europe, looking at some of the sectors across Europe. And what we'll see there, you can see banks. This is forward earnings estimates for banks are down more than 30% over the past 4 months. So they've been hit particularly hard. So I just want to now finish up with just looking at the health aspect and the number of cases. And all we're showing here is just the charts of the various countries since the first time they reached the 100 cases level, and basically the curve flattening across most regions. Certainly Australia, South Korea, probably less so in Japan, Germany, but the US is still a bit of an issue, as we can see there. So certainly good news, but there's still a number of countries, so it's a bit inconsistent, a number of countries that are still struggling to get on top in a sort of a sustainable way at the moment. Thank you.